factor because of which they were criticized so much in the past has been rationalized a lot, and therefore there is now an IRDA regulation that if you are investing in a ULIP for 10 years, the average expense ratio for the next 10 years cannot be more than 2.5%. So which makes them as close to a mutual fund in terms of the expenses, So overall expenses minus the risk cover has to be limited to 2.5% every year.
Would you advise individuals to look at ULIPs? Or would you say it's better to just stick with mutual funds because they're more traditional in nature in that sense?
So it depends on, as I said, like if you don't have a risk cover, probably some of your investment can be into ULIPs and some into mutual funds. But if you don't have, if you have adequate risk cover.
For a first-time view individual who's looking to plan his finances, assuming that he's got no insurance cover or nor exposure to his investments, would he then be advised to go after a ULIP?
See, if you ask me, I would like to basically have insurance and investment separately. More so because in mutual fund you have visibility of the returns. The NAVs are published in the newspapers every day.
So
you get a monthly portfolio. You get an account statement wherever you need. So you can track your investments much more closely. Whereas in ULIP, that visibility is a little lesser. So for a first-time investor, probably he should go into a mutual fund, experience that, and maybe go for a term plan in insurance. And then depending on his experience, probably he can also go for ULIPs.
There are so many types of mutual funds. They're broken down into diversified funds, mid-cap, small-cap, sector-specific funds. How does one decide what they should be investing in?
Yeah, so do
you need a good mix of all? Or not?
Not really actually, because if you look at a diversified fund, it's invested into large caps as well as mid caps as well as small caps. So the best that an investor, or the most that an investor can do is invest a little bit of his money into diversified funds or large cap diversified funds, and some bit of money into mid cap funds. So that can complete his basket. So going for sectoral funds is only meant for evolved customers, and only when they feel that that sector itself can have an upsurge. So they are more shorter term in nature. So let's say an infrastructure fund is best suited when you are seeing that there could be a high in infrastructure companies, and which will translate into higher share prices. And therefore you can take a bet on infrastructure through these infrastructure funds.
Right, Raghvendra, what is the taxation like on mutual funds?
So taxation is, so capital gains, any money that you invest, you have a choice to go for dividend or go for growth. The dividend in any case is tax-free in nature. And growth can be short-term if you have less than 1 year investment. So if you have more than 1 year, you have long-term capital gains. Short-term capital gains are taxed at 15% and long-term is tax-free.
What is the average returns one can expect over a long-term time horizon in mutual funds?
Very, it's difficult to say, but typically what I have seen is that the returns of equity matches with the earnings growth over the years. So if the earnings growth of the companies in the portfolio is, let's say, 20%, you can definitely expect a 20% return.
At an average, that would be your...
No, I'm just giving an example. Okay. But if it's 12%, you will get only 12%.
So if I had to ask you, what is a fair expectation?
I think 12 to 15% over next 10 years.
And anything beyond that is just being greedy.
Yeah. So 12 to 15%. If you get more than that, I think you should book profits.
And you would be advising investors to make those equity investments in a falling market like we have today?
Definitely, yes. I think, these are the best times to invest, because when nobody is investing, that's the time, because that's where the share prices are much lesser than what their actual worth is. And therefore, these are the best times to invest.
Right, that's advice coming in on investing in equities through mutual funds, the sort of tax saving that's available, what are ULIPs, and why one should be looking at equities as an investment opportunity. We'll take a break on that note. We'll come back and then take up all your financial planning related queries, so stay with us.
The Financial Planner, presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner.
Investment Ladder, presented by BSC, Investors Protection Fund.
Raghvendra, we've got a query coming in from Mithul Chariwala. He says he's from Surat. He's 33 years of age and has a daughter who's 11 and a son who's 8. He is planning to build a fund for for the graduation, marriage, and minor and major requirement of any family, including a lump sum amount for retirement, respectively. He's not really given us too much details about what the kind of income he's talking about, but he's looking at making investments of about 7,000 rupees. He doesn't even have too much insurance. What is your advice for him?
Yeah, so I think it's very good that he's starting early. 33 years of age is pretty young, and he's starting to think about his goals in terms of education, marriage, as well as retirement. It's a very worthy thing. My suggestion to him will be, since he has said that he has very limited amount of insurance, he should definitely go with a term plan. He can get a 50 lakh rupees term plan for his age at around 15 to 18,000 rupees every year. And he should, that will at least insure his family against any eventuality. The balance amount of money he can start investing, as he's saying that he wants to go through an SIP. It's the right way to invest. I was just doing some numbers. I think 7,000 rupees invested for next 27 years based on his age, since if he retires at 60, will give him something like 3.5 to 4 crore of rupees. If he invests this money into equities, and therefore which will be a very neat sum. So he can start investing the 7,000. The only thing is that he has his daughters and sons education, marriage and retirement, and 7,000 does not seem to be enough for that. So my suggestion to him will be to keep increasing the amount of investments as he goes into the future and as his income increases. And so, and it's for anyone, who is in this kind of situation, that as the salary goes up, people should try and control the increase in expenses. Okay. So whatever is the increase, a large portion of that should go towards investing or savings. And that way people can ensure that, they become wealthy over a period of time.
Do you advise him to also invest in fixed income products?
At this point in time, if he has to basically look at these goals, this 7,000 rupees, I think he can invest completely into equities.
Okay.
But if he has any other money, and we have very limited information, I'm sure he'll be putting some money away. If he's not putting any money away, then probably a portion of this should go into fixed income.
And any sort of funds that you recommend?
Yeah, so the funds will be, I think he should look at 1 or 2 diversified funds and 1 or 2 mid-cap funds. In diversified funds, he can go for, let's say, an HDFC equity fund. He can go for, let's say, a Franklin blue chip fund. Okay. In case of mid-cap, he can go for DSP small and mid-cap and SBI emerging businesses. Okay. Both of them are doing well. So these 4 funds he can go for.
Right. Mithul, that's the advice coming in for you. We'll take a break on that note. We'll come back and take up more of your financial planning queries.
Presented by BSC, Investors Protection Firm.
Welcome back. You're watching Financial Planner. We've got a fairly extensive, detailed query coming from Basudev, who writes in from Bangalore. He says he's 44 years of age, he's got a daughter who's 13, and he's got a wife who's 40 years old. His salary is about 44 lakhs gross. Net take home is about 25 lakhs. Daughter's education 6 to 7 years, marriage in 14, and retirement 16 years. And he's also told us the kind of corpus he's looking to build. In terms of liability, he's got an EMI of 34,000. He's also about to save about 50,000 per month, which is actually not a bad amount of savings that we are seeing. He's also got his insurance about 1.25 crores. He's got health insurance as well. And he's also listed out his mutual fund portfolio. He's putting away about 5,000 approximately in these funds. He's got a corpus of 15 lakhs in MFs in the above portfolios and a property of 60 lakhs and reserve cash and debt funds for 6 lakhs. He's got 2 cars. Can you tell him what if he's on the right track?
No, he is. He's definitely. I think he's definitely on the right track, and he's earning a good amount of money. So very fortunate, and he's also planned his investments very well. I think he's diversified. He has adequate amount of insurance. I think 1.25 crore is a good insurance amount. He's covered his health insurance beside what his company provides. So overall, I think he's planned his wealth wonderfully. The only thing that I may, I think he has said that he needs around 6 crore for his retirement. Looking at his expense, which he's earning around 25 lakh rupees and investing 12. So I'm assuming that he's spending on the other 12 that he's earning. Based on that, I think he may require something like 7.5 to 8 crore rupees for his retirement. Okay. So what he has provided for retirement is a little lesser, but I think it's still 6 crore is a decent amount of money. For his daughter's education and marriage, I think he has provided enough, and so he's adequately covered there. In terms of his investments as well, what he's doing is right. The only thing is he has too many schemes, and I think he can cut down on the number of schemes that he has. He has something like 9 or 10 schemes that he has, and therefore he can get out of this Nifty. It's not giving him anything. He can get out of, let's say, HDFC top 200 because he already have HDFC equity. He can get out of Prudence because he need not have a balanced fund in an equity portfolio.
Right.
So these 3 he can get out, the rest he can retain, and otherwise he's going good.
Is he well insured?
He's insured well. He has taken 3 lakh rupees health insurance for separately. Probably he can look at a family floater, and that will reduce his premium outgo.
And he's also got a contingency fund. Is that enough too, in your opinion, 6 lakh rupees?
Yeah, 6 lakh, I think it's good enough. I think he's doing otherwise quite well, and his investments are fairly well spread out. He has investments into real estate, he's doing equities, he has some fixed income investments as well. So I think he has a very balanced portfolio.
Investment Ladder, presented by BSC, Investors Protection Fund.
That's the advice coming in for you, Basudev. Thanks a ton, Raghvendra, for joining us
Thank
as
you.
well. Well, that's also all the time we have on this edition of Financial Planner. Thanks for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.